Hello. Today we'll talk about the cost of capital. Okay. So in some ways what the cost of capital does is, in previous chapters we talked about bond valuation, we talked about stock valuation, we also talked about portfolio theory in risk and return. So essentially what it does is that in terms of doing the computation, we are bringing together all these things together. Okay, so what is the cost of capital? Essentially, let's say we plug some numbers and we find that the cost of capital for Walmart is 15%. So what that tells you is that for every dollar that Walmart raises for investment, on average, the cost is going to be 15 cents. Okay, so Walmart as a company might have different types of securities. It has bonds outstanding, it has stocks outstanding, it might have preferred stock outstanding, and so on. So essentially what we do here is that from portfolio theory we know that we can find out the weight of each security. So in the case of a company like Walmart, we want to figure out the fraction of that security as far as the company's overall value is concerned, and then we are looking at the after-tax cost of that security. So here, what are some of the things we do here? Know how to determine a firm's cost of equity capital. So that's something we talked about in stock valuation. Know how to determine a firm's cost of debt. That is something we did when we talked about bond valuation. And then know how to determine a firm's overall cost of capital. Now, why do we care about the cost of capital? So basically, we know that the return on assets depends upon the risk of those assets. So the return to an investor is the same as the cost to the company. So our cost of capital provides us with an indication of how the market views the risk of our assets. So as an example, in recent times there have been a lot of mergers going on. So as an example, CVS bought the pharmacy division of Target. That's one example. Okay. Another example would be Dell took over EMC, which is a company based in Massachusetts. And other examples are the company that owned Firestone. Okay, they took over Pep Boys. So all of you know Pep Boys, and chances are you also been to Firestone. So these are all examples of takeovers. And one of the things that a buyer has to do, so whether that's a Dell or whether that is a CVS or whether that is a Firestone, they want to make sure that by buying the assets of this company, so by buying the assets of Pep Boys or by taking over EMC, in all these cases they want to make sure that they will at least make their cost of capital. So if by buying this new division they are not going to make that much money, even let's say 15%, it means that they should not be taking up this investment. Okay? So our cost of capital provides us with an indication of how the market views the risk of our assets. So that is a measure of the overall risk of our assets, and knowing our cost of capital can also help us determine our required rate of return for capital budgeting projects. So for CVS, they need the cost of capital in it to evaluate the value of taking over Target's pharmacies. It's one example. Okay. So the required return is the same as the appropriate discount rate and is based upon the risk of the cash flows. NPV, we need to know the required return for an investment before we can compute the NPV and make a decision about whether or not to make the investment. We need to earn at least the required return to compensate our investors for the financing. So basically what we are saying is that when you look at the weighted average cost of capital, one of the definitions of that is the marginal after-tax cost of capital. So marginal means the cost of the next dollar, and we are also looking at the after-tax cost. And the reason why we care about the after-tax is because we are looking at the firm's point of view. So from the firm's point of view, especially for the interest payments on the bonds, those interest payments are tax deductible. So that is the reason why we want to look at the after-tax cost. Okay. So basically here what we want to do is we want to go back and in some ways review some of the things we talked about before. So we want to talk about the cost of equity, we want to talk about the cost of debt, we want to talk about the cost of preferred stock, and finally we want to talk about the cost of capital. Okay. So how do we find out the cost of equity? So the cost of equity is the return required by equity investors given the risk of the cash flows from the firm. Okay. So as an investor, when you buy the stock, how much do you expect to make? That is the cost of equity. And that depends upon the business risk. It also depends upon the financial risk. So what is the business risk? The business risk depends upon the type of industry that a firm is in. So as an example, a company like Home Depot or Lowe's, they are in the home, they are in the business of providing materials for construction, and they also provide materials for do-it-yourself homeowners. So one of the things we see is that from 2007 to maybe around 2013, the housing market was not good. And when the housing market was not good, chances are people do not want to spend too much money on improving their houses or on new construction. So there, in that case, they face a risk that is very much dependent upon the economy. That's a type of business risk. Now, what is financial risk? The financial risk mainly comes because of the amount of debt the firm has. So suppose I make $10,000 per month. If I don't have much debt, I can have a very good life. Okay. On the other hand, if I have a lot of student loans, I have a mortgage on my house, and I have some credit card loans, I may not have much left at the end of the day. So the same thing for a company. When a company is financed with a lot of debt, so if you look at a company that is an LBO or a management buyout, those firms tend to have a high amount of debt. Maybe 90 to 95% is financed with debt. And there, that is referred to as the financial risk. So the financial risk basically comes from the type of financing that a firm has. And typically, the higher the amount of debt, the higher is the financial risk. Now, when you talk about the cost of equity, there are a couple of ways you can do that. One is the dividend growth formula. The other is the security market line or the capital asset pricing model. Okay? So what is the dividend growth formula? When we talked about stocks, what we said was the price of a stock is given by the next dividend divided by the required rate of return minus the growth rate. So that's what we said. And here, what is the required rate of return? So that is our focus. The required rate of return is given by D1 by P0, that is the dividend yield, plus the G, that stands for the capital gains. So that is the required rate of return for a stock. So that is the dividend growth formula. And how can you find out these numbers? Suppose your company is expected to pay a dividend of $1.50 per share next year. There has been a steady growth in dividends of 5.1% per year, and the market expects that to continue. What is the cost of equity? So the cost of equity is given by $150, which is the next dividend, divided by $25, which is the stock price, plus the growth rate. So that gives us 11.1%. So how do you find out the dividend growth rate? One of the ways you can do that is look at history, collect the dividends pattern over the years, and then find out the average dividend growth rate. Now, what is the advantage of the dividend growth formula? It's simple, straightforward, and easy to use. What is the dividend disadvantage? Only applicable to companies currently paying dividends. So companies like Facebook or Google, they don't pay any dividend, which means that we cannot apply this formula, and extremely sensitive to the growth rate assumed, and does not explicitly consider risk. So these are some of the shortcomings. The second one is to use the security market line, and the security market line basically tells you that the return of any stock is given by the risk-free rate plus the beta of the stock times the market risk premium. So here is an example. Suppose your company has an equity beta of 0.58 and the current risk-free rate is 6.1%. If the market risk premium is 8.6%, what is your cost of equity capital? So the cost of equity capital is given by the risk-free rate, which is 6.1%, plus the beta of the stock, is 0.58 times the market risk premium, and that gives us the 11.1%. Okay. So what is the advantage and disadvantage? The main advantage is that explicitly adjusts for systematic risk applicable to all companies as long as we can estimate the beta. What is the disadvantage? The main disadvantage is that we have to estimate the beta, and we are using the past to predict the future, which is not always reliable. So as an example, in recent times, AT&T took over DirecTV. So what that means is that trying to estimate the beta by going back, collecting the returns of AT&T over the last 2-3 years and estimating the beta may not give you a good picture of the beta of AT&T now, because right now AT&T is an entirely different company after the acquisition of DirecTV. So whenever the company has had big changes using collecting the old returns, estimating the beta, and using that may not be very sensible. Okay? Suppose our company has a beta of 1.5, the market risk premium is expected to be 9%, and the current risk-free rate is 6%. We have used analyst estimates to determine that the market believes our dividends will grow at 6% per year, and our last dividend was 2. Our stock is currently selling for $15.65. What is the cost of equity? So the cost of equity is equal to the risk-free rate, which is 6%, plus the beta, which is 1.5 times 9%. That gives you the 19.5. Now, if you use a dividend growth formula, that gives you 19.55. So clearly, these are textbook examples, and the numbers match mainly because of that. Okay? Now, what is the cost of debt? So the cost of debt is the required return on our company's debt. And basically, what is the cost of debt? The cost of debt is given by the yield to maturity of the bonds. So one of the things you want to make sure is that don't confuse that with the coupon rate. Okay. So we focus on the cost of long-term debt or the bonds issued long-term. So let's look at this example. Suppose we have a bond issue currently outstanding that has 25 years left to maturity. The coupon rate is 9%, and coupons are paid semi-annually. The bond is currently selling for $908.72. What is the cost of debt? So basically here we are going back to what we studied in chapter on bond valuation. So the price of the bond today, that is the present value. The future value is $1,000. The number of payments is going to be 50 because it's 25 years. It's a semi-annual bond, and each payment is going to be, the annual coupon rate is 9%, so $90 per year, and it's going to be $45 every 6 months. So once we have that, we can find out the interest rate. The interest rate is 5%, and the yield to maturity is going to be double that, which is 10%. Okay? So basically here we are looking at the yield to maturity of the bond. Now this is the before tax cost of debt. Now as far as the company is concerned, we want to look at the after tax cost. So what is the after tax cost? That is going to be the yield to maturity times 1 minus the tax rate. Now what about preferred stock? The preferred stock, generally we assume that it's a constant dividend every year, and we assume that it's a perpetuity. So when we talked about finding the price of preferred stock, what we did was take the dividend, annual dividend, divide that by the required rate of return, and to find out the return for preferred, all that we have to do here is we want to take the dividend and divide that by the share price. So your company has preferred stock that has an annual dividend of $3. If the current price is 25, what is the cost of preferred stock? So here the cost of preferred stock is going to be 3 by 25, which is the 12%. Okay. So how do you find out the weighted average cost of capital? We can use the individual cost of capital that we have computed to get our average cost of capital. The average is the required return based upon the market's perception of the risk of those assets, and the weights are determined by how much of each type of financing we use. Okay, so here the weight of equity is given by the amount of equity the firm has divided by the firm value, and the fraction of debt again is the percentage financed with debt. So that is the amount of debt divided by the firm value. So here, suppose you have a market value of equity equal to 500 million and a market value of debt of 475. What are the weights? The weights are 500 over 975, which is 51.28, and 475 divided by 975, which basically gives you 48.782. So these are the weights of each security. Now, as we said before, the taxes and the weighted average cost of capital, we are concerned with after-tax cash flows. So we need to consider the effect of taxes on the various costs of capital. So the after-tax cost of debt is the yield to maturity times 1 minus the tax rate. So let's look at an example. So in this case, the firm has 50 million shares. The share price is $80 per share. The beta is 1.15. The risk-free rate is 5% and the market risk premium is 9%. The firm has 1 billion in bonds outstanding. The quote is 110. The coupon rate is 9%, 15 years to maturity, and the tax rate is 40%. So why are we given these numbers? So given the 50 million shares at $80 per share, we can find out the amount of equity the firm has, and given the 1 billion in outstanding debt and the current quote of 110, it basically means that the firm has $1.1 billion in bonds outstanding. So we have 4 billion in equity and 1 billion in bonds outstanding. So the firm value is 4 plus 1.1, which is 5.1 billion. And given the information on the beta, the risk-free rate, and the market risk premium, we can find out the use the CAPM to find out the required rate of return. And based upon the information given for the bonds, we can find out the yield to maturity. So what is the cost of equity? The cost of equity is going to be the risk-free rate, which is 5, plus 1.15, which is the beta, times 9, which gives you 15.35. What is the cost of debt? Again, we can plug in the numbers. The present value is $1,100. The future value is $1,000. The payment is 45. The interest rate is 3.9268. And the yield to maturity is going to be double that, 7.854. The after-tax cost of debt is going to be the 7.854 times 1 minus a tax rate, which gives you 4.712. Okay, and once we have that, we can figure out the weighted average cost of capital. So here, the fraction of equity is the 4 billion divided by 5.1. That gives you 0.7843, and the cost of debt is going to be 21.57. And based upon that, the weighted average cost of capital is going to be 13.06. Okay. So to summarize, what we did here is we talked about finding the weighted average cost of capital. And what is the weighted average cost of capital? So the definition of the weighted average cost of capital is the required rate of return for a firm. And the weighted average cost of capital is the marginal after-tax cost of capital. So that is the cost of the next dollar that is on an after-tax basis. And how do we find out the weighted average cost of capital? That is the weight of each security multiplied by the after-tax cost of that security. In the case of stocks, what do we do here? In the case of stocks, we can find out the cost of equity either using the CAPM or using the dividend growth formula. Okay. In the case of bonds, the cost of debt is the yield to maturity, and again, based upon what we studied about bonds, we can find out the yield to maturity. And the cost of preferred stock is the annual dividend divided by the share price. So once we have that, we can find out the weighted average cost of capital. So here, what about divisional and project costs of capital? So what we are saying is that in recent times, we find that a company can have different divisions, and the divisions can be quite unlike each other. Okay? So as an example, Microsoft has different divisions. They are the software business. They are the hardware business. They make the the Microsoft PlayStations. Okay, and Microsoft has their hardware. They have the Microsoft Pro, the Surface Pro, and so on. So what we find here is that these different divisions are quite unlike each other. So what does it mean? It basically means that we cannot use one cost of capital to evaluate all the divisions. And here, divisions often require separate discount rates. Okay? So how can we find out the separate discount rates? So as an example, we have a company like Walmart. They want to get into the pharmacy business. So in that case, to find out their cost of capital for their pharmacy division, what they can do is they can look at companies that are purely in the pharmacy business. So some examples are CVS, Walgreens, Rite Aid. So these could be examples of companies, and we can use the average beta of those companies to find out, to determine a cost of capital for the pharmacy division. Okay. Now the other one is the subjective approach, and it's a very ad hoc method. So what do we do here? If the project has more risk in the firm, use a discount rate greater than the cost of capital. If the project has less risk, use a discount rate less than the cost of capital. So it's a rather ad hoc way to find out the cost of capital. So here we have some adjustments. Very low risk, take the average cost of capital and subtract 8. Low risk, subtract 3%. High risk, plus 5. And very high risk at 10%. Okay? Now what we are saying is that whenever a company sells new stock, so that could be an IPO. IPO means that it's an initial public offering, or that could be an existing firm selling new stock. In both those cases, the company might have to pay investment bankers, lawyers, and accountants. And usually for an IPO, the cost of issuing equity is around 7%. Okay? So what we are saying is that we have to incorporate the fact that our cost of equity or our overall cost of capital can go up because of the flotation cost. Okay? So we want to find out the weighted average flotation cost and using the target weights. So here is an example. Your company is considering a project that will cost 1 million. The project will generate after-tax cash flows of 250,000 per year for 7 years. The cost of capital is 15%, and the firm's debt-to-equity ratio is 0.6. The flotation cost for equity is 5%, and the flotation cost for debt is 3%. What is the NPV of the project? So here, the average flotation costs are going to be the weight of equity debt, which is 0.375, times the flotation cost of debt plus the fraction of equity, which is 0.625 times the flotation cost of equity. So that gives you 4.25. And the present value of the future cash flows, we are assuming that it's an annuity, 7-year annuity. That gives you 1,040,105. Now what we are saying is that we also have to incorporate the fact that our flotation costs can bring down the value. So basically here, 1,040,105 minus the 1 million we have to raise times 1 minus the flotation cost. So basically here, what we are saying is that without incorporating the flotation cost, the firm would actually create value of 40,105. But once we incorporate the facts that issuing new securities is going to cost you around 4.25% for every dollar raised, in actually, by taking this investment, we are losing money. Okay, so I think this is a very important chapter, and you want to make sure you understand the different things we talked about. We talked about the cost of equity, we talked about the cost of debt, and we talked about the cost of preferred stock. And we put together all of these things when you determine the weighted average cost of capital.